Africa. It's a privilege and a pleasure to just talk about personal finance and retirement planning before this able audience. It's going to be an interactive session, so feel free to come in. Feel free to come in either through questions or through additions. And then I believe that at the end of it, we will all learn together. So I'll put in my video up as well, so then you can, okay, no problem. I see the host has stopped it. So we'll just progress. We are talking about personal finance and retirement planning. So personal finance, it's important to begin from the known to the unknown. So what is personal finance? By introduction, personal finance is as personal as the name suggests. Personal finance is it's finance or money that is available for you to spend in whatever way you choose to. So that's why even how we ought to manage this is encouraged, and it's important to our life, because our behavior as human beings have an impact in our life. So even how we manage our finances also have an impact in our lives. And finance or money is one of the greatest enablers of in our society. When you have money, then you can be able to do a lot of things. There are common sayings that money cannot buy happiness. There are common quotes about money, which I know we are all familiar with. But money is good for what it allows you to do. So personal finance is basically just how to manage your money, and this involves making financial decisions. It could be in a family setup or at a personal level. And it has various elements, which includes budgeting, investments, and retirement planning, which I know we are going to look at. So when you effectively manage your finances, or when you save your money, you're basically doing a trade-off. You are what is called an opportunity cost. You are deferring your gratification. Sometimes we want to be gratified instantly. We want things that satisfy our needs like immediately, and so we make a decision to spend money on a certain thing. But I'd like to encourage us from the onset that personal finance and one of its tools, which is budget, just helps us to know where our money goes. So it involves three elements, really. First one is financial management, strategies, and financial discipline. Without discipline, then there's nothing you can do, as you can all agree with me. So we'll begin by just financial management. Financial management involves creating a budget, choosing a right financial institution, managing your debt, investing, and having a retirement plan. These are the major elements of an effective or a sound finance management, either in a family setup or at individual level. So a budget is the main finance management tool. You have to have a budget. So once you have your money, or even before you have it actually, you need to have a budget. A budget is just a tool that helps you know when, not when, but where to put your money, how much or what percentage or proportion of your income goes into what. Once you have that idea, then when you have the money, then you can direct it. Money, how you spend money speaks much about your beliefs or how you manage yourself. It's more about self-control. Finance management from the onset is more of self-control. Are you able to control yourself? What level of self-control do you have? If you have poor financial habits, then chances are very high that you don't have self-control, and so you make decisions based on emotions. And this even spreads into other areas of your life. If you lack self-control as a person, then you basically don't have principles, and you are not willing to abide by any little principles, if you may have any. So in the financial management topic, we are going to look at savings and investment strategies. We are going to look at a bit of a budget and or a spending plan. And then we are also going to look at debt elimination. If you find yourself in debt, then what do you need to do? So what saving strategies can we then consider? And what is a savings anyway? Of course, savings is the income that you don't spend, or it's your deferred consumption. So once you have your disposable income as a person, then there are some basic needs that you have to spend money on. And then what remains, what you will not have spent, then will become your savings. But I won't go without saying that in most cases, and there's a 20% rule that we're going to look at in the next slide that may help us even begin saving if we are yet to. Sometimes when you get money, you are encouraged to put 20% aside for savings. Do not save what has remained after you have spent, but spend what has remained after you have saved. So how does one save? Saving is a culture. And for you, for a culture is out of a habit. It's developed out of a habit until you become comfortable with it. So what we are saying, or what I'm saying in a nutshell, is that nobody, if you are poor at savings, or if you're good at it, nobody was born with savings attributes naturally. In fact, naturally, we will not, as a human being, naturally, you don't like saving. We would like to spend or to receive instant gratification. So I'm saying that saving is a habit that you must cultivate. So if you're not currently saving, then just know that there's a possibility that you can begin saving if you develop the correct habit. So there's this 20% rule that is very famous that I'd like, that will be a good point to start for anyone who would like to save. So once you receive your paycheck, as I said earlier, take 20% to a designated savings account before buying or paying for anything. So it means that out of your income from whatever source, it could be from employment, it could be from a business, it could be a rental income, it could be anything really. So any money that you receive, it means that then you have 80% to save, to use. At least start by saving 20%. If you can save more, the better. But try to really live within your means. I think we're going to expand on that as we progress. So upon saving this 20%, now what are the instruments that are available for you to? What are the instruments that are available for you? Of course, the saving instruments that are encouraged are interest-bearing savings. Do not save your money where your money does not earn interest for you. You are encouraged to use interest-bearing accounts that are held by financial institutions, which include banks. So ensure that it is separate from your everyday, the accounts that you normally use on a daily basis. That is when you can actually save money. And ensure that you know what returns do those instruments offer. So those are some of the elements that you need to consider. Do not save in an account that you don't have their terms and conditions at your fingertips. You need to save with some level of knowledge. So when you have interest-bearing saving instruments, then you're allowed to enjoy features such as an interest on your deposit. Some of them will give you ease of access to your money, the ability to even write checks. So I encourage you to consider interest-bearing accounts or saving instruments. Some of them are listed here. There's the deposit savings account, which is the simplest way to store your money. There's the certificate of deposit. Then there's the money markets. So those are some of the saving instruments that you can consider. I'd encourage you to go and just look further into go and look further into more about this. So saving has to begin. You must make a personal commitment to yourself that you want to save, so that then it becomes a habit. There's a 21 and 90 rule that might be familiar to some of us, if not all, which states that it takes 21 days to develop a habit, and then it takes 90 days to develop a culture or a lifestyle. So there is hope for you that you can, begin saving, or you can develop whatever habit that you're looking to cultivate, and try to implement the 21 and 90 rule. And this 21 to 90 rule requires consistency. You have to be consistent at whatever thing you want to achieve. So how do then reach your savings objective? And even before we go into this, it's important for us to note that for you to achieve anything, including your financial goals, it has to begin from an objective or a goal. So you need to have your financial goals right. As a person, you need to have goals in life. At least if you don't have financial goals, then you need to have certain goals in your life. But financial goals are very important because some of our personal goals will require financial support. So that's why this aspect is very important. So please develop habits of having goals, including financial goals. So how do you then reach those objectives or goals? There are certain things that you need to consider. What are they? Figure out how much you earn. Figure out how much you earn. So how in my present situation, how much do I earn? It could be through employment, it could be through business, it could be through even friends or families who are supporting you. It could be through any source, rental income, it could be through anything really. But how much what are your current, or what are your cash inflows? What money, how much comes to your pocket? And then also consider what you spend and what you owe. We have a spending habit, even if whether we know of it or not. If you've not been intentional about considering this, then you can just sit down with yourself and then figure out, perhaps in the last 3 months, what are the things that I've consistently spent my money on? You'll find that there's a pattern. Statistics do not lie. Those will be then your spending habits. You also need to consider how much you owe, or what are your debts. It could be through, maybe you studied through the HELB, or you took a loan to do a business. So it's important to know how much you owe. Could be even in terms of your commitments. I normally like those who are very honest and those who keep their words. If you told someone that you'd support them by this amount of money, maybe at the end of the month, then it's important that you meet it. Be someone who keeps their words. And financial literacy will even help you not make promises that you will not follow through. So that is very important. Reflect and change your expenses. Upon determining what your spending habit is, you're also encouraged to, of course, you'll have to reflect. This is how I've been spending my money over the past. What do I need to change? What are some of the things that I didn't need that I spent my money on? What are some of the things that I can, that I spent my money on that perhaps I need to spend more? Sometimes there are certain things that we sometimes you spend money to make more money. So if there are certain goals or skills in your life that will require, that have come handy, I normally say that people are paid for their skills. So an investment in self is the most important kind of investment. So when you invest if you need to invest in yourself in more, I'm not saying that, and this lesson is not to encourage us to spend less, but just to spend on the areas that are important. Sometimes there are certain areas in your life that if you spend money on, then you get more money in return. So we are not encouraging you not to spend money, but also just spend your money intentionally and in areas that will allow you to then make more money. So upon reflection and making necessary adjustments, then you will have your budget with you, and then you do a review of your budget holistically upon it. And there are 3 kinds of budget. There's a surplus budget where you find that you are income is way more than what you intend to spend. Then there is the balanced budget where your income is equivalent to what you intend to spend or the spending or expenses. Then there is the deficit budget, which you find that there's more on the expenses side than what you're earning. And I say as well that sometimes you may find that even for you to live a normal life, because I understand that human beings have basic needs which has to be met. So sometimes you can find that your basic needs are way expensive than what you're earning. So sometimes it could be, you could have an income problem. So just do a reflection and then find out whether your problem is an income problem. Sometimes it's not how we spend. You may find that, especially if you are staying in the city, sometimes there are certain things that you have to spend money on because they're important to your survival as a human being. Do not die when you have money lying somewhere. So take care of yourself, even as we intend to have sound financial habits. So you need to know whether you have an income problem and always aim to increase your portfolio and always aim to get more money, of course, in the right way. So remember that a penny saved is a penny earned. So when you have your money, when you save your money today, tomorrow, when you find yourself in a difficult situation, then it will come through for you. I cannot overemphasize enough on the benefits of saving. We all know that. So savings comes with some very good benefits. But the most important of them is that it helps you realize your future goals. What are investment strategies? So what are the investment baskets or investment vehicles? So there is the equities. You may decide to trade in equities. You may decide to trade in treasury bills, treasury bonds, or unit trusts. But ensure that even before you start investing, there are certain questions that you need to ask yourself. And I'd like to they are not in the presentation, but there are some investment considerations that you need to have. So before you start investing, you need to consider these things. One, duration. How long can you afford or do you want to invest? Secondly, what are the returns? Do you prefer income or do you prefer growth? The third one is liquidity. How fast can you get your money back? How liquid is the investment? And then the fourth one is risks. What balance of risk and rewards is right for you? And what is your level of comfort? So you need to know what level of risks that you can bear. So these are the investment vehicles that you can utilize. So to begin, the first one, equities. You can decide to take an ownership in a company. When you buy a share in a company, then you become an investor, become an equity shareholder. And what you earn is dividends. So just know that before you begin trading, if you have to trade in the stock market, you need a CDS account. So that is also a point of consideration as well. So the value of shares sometimes is volatile. Sometimes it can go up, sometimes it can go down. So you can either make money or lose money when you invest in equities or any form of investment basket. Then treasury bills is a debt instrument that is issued by the government. They are considered as a defensive investment because they generally offer lower potential returns and lower level of risk than shares. It's normally said that the government cannot default in its loans. I mean, when you give loan to government, you can be sure that you'll get it back. I don't know how true that is, considering the current situation we find ourselves in, especially as Kenya. But investments in governments are considered to be low risk. And there's this basic rule in investments where if a lower risk, you get low returns. The lower the risk of investment in an investment, then the lower the returns that you expect. And the higher the risk, then sometimes the higher the returns in most cases. Those are not absolute rules. They apply sometimes they do not. So they can also be sold relatively quickly. So treasury bills are very liquid, and they're usually offered in 91 days, 182 or 35 days. So treasury bonds is a long-term version of the treasury bills. They take up to 5 to 10 years to maturity, and they're usually for risk-averse individuals. Then you can invest in unit trusts, where you accumulate your wealth in which investors' contributions are pulled together. Now, investor in this case is yourself, me, who is deciding to put their money to purchase a portfolio of financial securities that is managed by professional fund managers. So you need to know which fund managers and what are their terms and conditions. The profit derived are channeled to your individual unit owner of reinvesting them back into the fund. So how can you grow your capital over time if you are someone who is keen on growth? I said earlier that one of the considerations as we are investing is returns. So do you prefer to get income or you prefer growth? So in case you prefer growth, then we can do some quick math just to demonstrate to us how when we invest, sometimes our money becomes or grows over time. So let's say you invest 200,000 shillings, Kenya shillings, in an investment capital, and you receive 10% of dividends on your invested capital. So it means that with 10% dividends on 200,000 investments in Kenya shillings, that it means your dividend is 20,000. If you decide to plow back that dividends and put it to your initial investment, then at the beginning of year 2, you will have 220. 10% dividends at the end of year 2, then your dividends will be 22,000. If you decide to plow it back again, then at the end of year 2 or at the beginning of year 3, then you'll have 242. So if it continues over time, then your money grows over time. So there's a concept of time value of money that you also need to be familiar with if we are not. I'm not going to belabor that, but it's very important for us to understand. This is just a session to do a highlight, but really you may want to go and dive in deeper to try to understand. Because as you make an investment decision, then you have to make it from a point of knowledge. Do not be dependent on the fund managers. Do not invest in something. Be someone who is not convinced by someone else to invest in a specific investment vehicle. Do your own research. All materials for research are available. Be comfortable. Understand your financials, and then invest. Do not take people at their words. While that is important, but you need to be comfortable yourself. Go and do your own research, and then be comfortable, so that at the end of it, you will not be washed in the city. The city is quite tricky, and people are looking for various ways to make money. So do not allow someone to mislead you into making a financial decision. So make a financial decision from a point of knowledge. So to grow your capital, you will need to invest regularly. You need to reinvest your dividends or interest, and you need to diversify your portfolio. We have talked about reinvesting. How if you reinvest your dividends or your interest, then your capital can grow over time. But on the third point, which is diversifying your portfolio, it's important because when you diversify, all the portfolios of investments or the investment vehicles, they have their risks. And so sometimes macroeconomic factors can cause a shock on a particular investment vehicle. So if you've invested everything in one investment basket, then sometimes as an investor, you'll be impacted. So it's important that you diversify your portfolio, invest in a money market, then also just invest in treasury bills, bonds. So always, if you are an investor, you are encouraged to invest in many things. So how then can you create value to your finances? This is a bit self-explanatory. So I'll not belabor it. Importance of investments is very obvious. And then a budget, also, I have talked about it earlier. but basically it's just an estimate of your income and expenditure for a set period of time. And then I also took us through 3 types of budgets: deficit, surplus, and a balanced budget, just as a refresher, if you may have forgotten. But what you need to know about a budget is not there to police us, but a budget is there to give us more control about our money. So a budget is good. It allows us to control our money. If your current budget doesn't leave you with money to save, you'll need to review expenses to make room for savings. Savings are very important. A penny saved today will save you tomorrow. So if you have a budget which do not support savings, then you may want to look at your non-essentials. What are the non-essentials in your budget? What are the things that you actually don't need? You may either reduce or eliminate them. But you need to know what are the things that you don't need. What are the things that are important to you? At the end of it, you're a human being, and you have to spend money. So the process of budgeting is rather simple and direct. You need to start with an aim, set realistic goals, then determine your income, calculate your expenses, or you can calculate your current expenses, and determine your income, then separate your needs from your wants, then you design your budget. So a budget is as simple as that. Do not have a mental budget. Ensure that your budget is in a spreadsheet or it's written. I do not have a mental budget. Most of us do, but do not have a mental budget. We are encouraged to actually write down our budgets. So benefits of budgets cannot be understated. Of course, I said it gives you more control over your money. It doesn't take away your control, but budget simply gives you control of your money. So if you want more control of your money, then it's important that you develop a budget. In case you find yourself in debt, you may want to eliminate it or repay it. So debts are amounts that you owe someone or an institution, and they're due. And the debts are bad because sometimes they derail your long-term financial goals. Sometimes debts are bad, sometimes debts are good. It just depends what purpose are you in debt. So you find yourself in debt, and I said, before you take a debt, you need to understand the cost of debt. You need to understand the terms and conditions of the debt. Do not take a debt that has very high interest rates, where you pay even like 100% of the principal. So it's important to know the terms and conditions of the debt. If you find yourself in debt, you can eliminate your debt by knowing exactly how much you owe. Do not be someone who you don't know how much you owe. Everyone is chasing left, right, and center. So know how much you owe, and then make a list of the lenders and the amount you owe, the terms of the loan or the repayment period, and the interest rates and fees that accrue. Then you can consolidate some of the loans, especially if they are from the same institution or the same person, so that you have one that you are servicing. So know how much you owe, consolidate the ones you can. You can renegotiate with the people. There's an example here that I will not take us through, but really it just says that if you have a debt that is due in 12 months, 6 months, and 3 months, it's important to start with the debt that is due in 3 months so that you clear it as you move into the other periods. How then can you use loans to your advantage? Of course, loans or debts are not bad, but how you use them is what matters. For example, if a bank gives you a loan at 14.5% rate, or a SACCO lends you at 12% per annum, and then you say you save in an investment that gives you a return of 20% per annum. So you know that is really good, because if you took a loan from a bank at 14.5% and you are reinvesting it in an investment that gives a return of 20%, then it means that you're making a 5.5% return. But if you borrowed from a SACCO at 12% and you're investing in an investment vehicle of 20%, then you get 8%. So just know for what reason are you borrowing. However, take advantage of families and friends. Invest in social capital. They are angel investors, please. So you can take advantage. And sometimes loan or debt should be your last option. So there are some various strategies that you can figure out how much you earn, categorize expenses, reward yourself first, of course, to the savings. It's important to create an emergency fund, create a budget, and open a retirement fund. So financial discipline is very important. It's easier said than done. So how well you're able to conform your spending and saving to the plans that you have to achieve your monetary goals, that lies the financial discipline. So be financially disciplined. To attain financial discipline, you'll need your goals. You need to be accountable for your spending. You need to stay focused. You need to be patient with yourself, refine your everyday practices, and you need to believe in yourself. Why is it important to be financially disciplined? That cannot be understated. Of course, it helps you become more productive. You find yourself, if you're not financially disciplined and you find yourself in a lot of debt, sometimes you have a lot of anxiety in life, and anxiety then makes you less productive. You live a more fulfilled with life with greater satisfaction, and you live a happier life. You're not someone who is then, you don't want to meet people because ukienda huku, you have someone's debt. You're being asked, if you go this side, you feel ashamed. So do not want to live such kind of lifestyle. And of course, more importantly, it gives you a more sense of direction towards a life that you want to live or you want to have. At that point, I'd just like then to take us quickly through retirement planning in the next 5 minutes. Then I'll open it up in case there are further comments or questions, we'll take them up. As a way of introduction, retirement planning is important for everyone. Do not wait until you're approaching your retirement age. That is when you start figuring out your retirement plan. And retirement, there's no specific really age for retirement. You can choose to retire early if you made proper financial decisions. Importance of saving for retirement cannot be understated, cannot be underscored enough. But there are many reasons why it's important to save for retirement, which include it ensure that you have enough money to live comfortably in your later years when you are now old, to avoid having to rely on your children or the government for financial support. It gives you peace of mind knowing that you are financially secure. By planning ahead, you can ensure a comfortable retirement and avoiding financial stress. Those are very obvious points. But to get started saving for retirement, how do you go about that? Of course, you set your retirement goals. Start by envisioning your ideal retirement lifestyle. What kind of lifestyle do you want to have upon retirement? And if you have noted, something that has been common through this presentation is on having an aim or an objective. You must have, it gives you a sense of direction. So if you want to achieve anything in life, then you must have a sense of direction. You must have your goals right. So set your financial goals. Determine expenses you're likely to have, such as housing, healthcare, travel, and hobbies. Set specific goals, financial goals, to help guide your savings and investment strategies. So once you have your retirement goals right, then you assess your current financial situation. It's important to know and as I begin this presentation, I made a comment, it's good to start from the known to unknown. Your current financial situation is the known. Ensure that you are intentional about your current financial situation. And the only way you can make it or move out of that situation is to recognize that situation. So you have to recognize your current financial situation, appreciate it for what it is. If you may know it's because of your previous decisions, and then know what you can change, so then you can get where you want to get into. So assess your current financial situation by knowing your current financial status. What are your current savings? What are your investments? What debts? Calculate your net worth to understand your overall financial position. Consider your income sources. Then you can diversify them. Then you estimate your retirement needs. Evaluate your estimate your retirement needs. I think I talked about this earlier, where you'd need to know what kind of lifestyle you want to have, and what will it take to facilitate that kind of lifestyle. So there are different types of retirement savings plans. You can have individual retirement account. There's the 401k plans that is matched by your employer if you're in active employment. There's an amount of money that your employer matches. terms of pensions. So there's also the government plans, I don't know how effective this is now, but then there's also the National Social Security Funds. So what you need to know that each plan has its own advantages and disadvantages, and this applies to even the investment vehicles we talked about earlier. There are advantages and disadvantages, and these are things you need to understand even before you make a financial decision. And upon understanding the advantages and disadvantages, then you may choose which plan is right for you. Common retirement and planning mistakes that we often make: we don't save enough money, we do not start to save early enough, we do not choose the right retirement savings plan, we do not take advantage of tax breaks, we do not. So it's important then to avoid this mistake that you achieve your goals. Remember, the amount of money you need to save for retirement will depend on a number of factors. It includes what's your current age, what is your income level, and what are your expectations, what are your lifestyle expectations. A good rule of thumb is to aim to save at least 10 to 15% of your income for retirement. So as I conclude this and just invite any comments, if we implement sound financial practices and the planning for retirement, we can build a solid financial foundation and enjoy a financial secure future. So start today and take control of your financial well-being. Financial wellness is very important. It's important to be well financially. Financial well-being is very important. Otherwise, I'm happy to now engage us in a short discussion, and then we will then hand it over to the coordinator. Yeah, I see there's a question on the chat box from Phoebe Ongale asking for 1K, what it means. For 1K, it's majorly used in US, but what it basically means is it's just like the pension scheme. It's how the US call their pension, US English. So it's basically maybe 5% of your gross income you pay towards pension, and then your employer matches a similar amount. So let's say you are earning 1 million, or let's say you're earning 1 million. If your pension scheme, if your employer pays 5% of that, then you also pay 5% of that. So you pay 5% of 1 million, or whatever amount it is that you're earning. Then your employer also matches a similar amount. And so it means at the end of the month, or whatever period it is, then you'll have saved, let's say, like 10%. I hope that answers for 1K. I see there's another question. I heard you mention something about wills. Would you expound on that? Gucha, confirm I can still be heard? Or
yes,
anybody?
yes, you're audible.
Okay, fantastic. So I heard you mention something about from Gathoni Kamau about wills. Would you expound on that? Okay, I don't think about the wills. What I mentioned was treasury bills. I didn't mention something on a wills, but a will is just basically if you have some level of, if you have how you'd want your money, your wealth or investments spent upon your death. So it's important that if you're a parent, or if you are any one of us can die anytime. If you have some levels of investments, then it's important then that you write a will. There's a beneficiary. Even in your savings, you will always have a beneficiary, someone who would receive those benefits, or someone who would benefit out of when you get to, if you die, which all of us will at some point in time, but if you get to die, then they become a beneficiary. unless you wanted me to expand on the treasury bills, Garoney, but I think that should be comfortable on the wheel.
I'm satisfied, thank you.
Okay, thank you so much. There's another question on the chat box from Jane Joki, and he's asking this to everyone. How do you classify crypto and Forex trading? Is it an investment? And because this has been asked to anyone, to everyone, I'd just like to, if there's someone who has something to say on crypto, if someone who is doing Forex trading, then I can also have an addition. And then I think Njoki should be comfortable. Anyone would like to speak?
Okay. Yeah, I can see there is one in the chat box.
Yeah, there's a response in the chat box. Kevin Kipkemoi saying that Forex and crypto things are no longer legit. Ni wash too, game chafu, not an investment. So Forex trading is it's very volatile. I personally will not classify it as an investment. Yeah, I will not classify it as an investment. Sometimes you don't get real money. So it requires a lot of knowledge of the stock markets. So I just encourage us, anything really, you need to do it from a point of knowledge. Do not be convinced by anyone to invest in any investment basket. Do your research and identify. It's good to share knowledge, but don't take everyone in their words. Do not, what I mean is, I'm not saying that we do not consult with financial institutions, but at the end of it, someone should not convince you to invest in. They should only be able to present to you the advantages and disadvantages, but making the ultimate decision should lie with you in anything really. So Duncan Ngahu has also just added a voice to what I said. It's a speculative instrument, that is the crypto and Forex. It's very volatile and it requires one who has a very high risk appetite. So you need to understand how much risk you can take. Do you have high risk appetite or do you have low risk appetite? And a basic rule in investments, high risks, high investments, although it doesn't apply to all, but in most cases. Low risk, low investments, low returns. Because what investment managers actually do, if you give them your money then you'll get, like, let's say you invest in a money market. There are certain fees that they charge you, and then they just take the risks for you. So you have to pay for the level of risk that you're giving someone. If you're giving someone a high level of risk, then you expect to pay more. If you are giving someone a low level of risk, then you're paying. If you're giving someone a low level of risk, then also what you get in return will be low. So really, it's just transferring risk. And diversifying our portfolio helps us to diversify risks as well. So there are risks involved in all investment baskets. No investment basket promises and returns, but just understand what you are investing in. Where is it that you're putting in your money? More importantly, investment in self is the most important kind of investment. Invest in ensure that you eat good food. Invest in good health, invest in your skills. That is what is more important. If you invest in yourself, then you can be able to make more money and invest in other vehicles. I won't stop without saying that. Any other comments or questions before I hand it over to our coordinator? You see, we have 3 minutes to 1 to the top of the hour. Okay, so I think I'd then hand it over to Gucha. It has been a pleasure. Let's talking investments. Let's keep reading more about investments. Let's keep saving, and I hope we can have a good we can achieve financial wellness. But more importantly, let's have financial goals and have them right. Thank you so much. It was a privilege and a pleasure.
All right. Now, thank you so much, our esteemed speaker, for today. I hope we've gathered some things home that are very important as we soldier on with our daily lives, including looking for employment, earning incomes, and managing our investments, savings, and all that. Now, there being no any other concern, question, I think that is well, everything is well placed. And I really thank you for slotting your time to attend this webinar. And